when I sat with Cameron, I told him, I said, look, to keep you from over trading, to keep you from having the issues and worrying about where your stop loss should be moved or where partial should be taken, you can only trade with one contract. And initially, I wanted him to trade with a micro. That's what I wanted him to do. And it wasn't about the amount of money. It was about him learning discipline and seeing the compounding effect of doing one thing well and just letting it happen over time. Keep doing it, keep doing it, keep doing it. Because if you do very, very well and you can find 10 handles very easy, very quickly, go in and find it. This is applicable to Forex, by the way. I know everybody likes to ask me questions like, I didn't fucking say this before, but it works in Forex the same way. Any market. It's the same thing. Liquidity and inefficiencies are the thing. Everything else is nonsense. Everything else is fucking bullshit. The idea of anticipating intraday volatility, that's what his model is. He's not even using the weekly bias. He's not using a daily bias. He's not looking at anything except for what's existing right now in price action. Now think about how easy this is. See, you're already going to doubt it because I'm not telling you to use the weekly bias, and I'm not telling you to worry about daily bias, because all of you think that you're going to be extremely profitable if you know what the daily bias is. That's bullshit, because I had students that could send me an email and I made them prove to me that, because they would say, ICT, I know the daily bias in blah, 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 but if I could know the right PD array on this particular model, I would be profitable. Okay, well, I demanded them, okay, before the trading session opened, I need you to send me an email. Tell me what the bias is going to be. And they were incorrect. So to keep the whole bias issue out of the equation, to simplify it, just trading intraday volatility. That means whatever the market's going to do from the highest high and the lowest low, that it will form that day, which you don't even need to know that. I have tools that'll do that. I've proven it publicly that I can fucking tell you what they are. And you watch me trade them. Now, intraday volatility, that means you're going to be looking for an hourly or basically a 60-minute swing high or a swing low that is likely to move to. It's in close proximity to it. It's been going up for the last couple hours or so. And it's just getting real close to an obvious 60-minute high. If it's not doing that, go down to a 15-minute time frame. Look for a swing high that it might be gravitating to. If it's gravitating towards that 15-minute high, and real important, here's the filter, folks, okay? This is the fucking part that you're not going to do, and when you fucking lose, you're going to swear up and down that it fucking fails. On a 1 or 5 minute chart, if you're bullish, it must show a swing low taken and then reject and go higher. Whatever time frame, whether it be the 1 minute or 5 minute, whatever time frame that swing low is breached, it goes below it. It only needs to go by one tick. Doesn't need to close below it either. It just needs to go below it. That time frame that has the swing low, it must have a candle close up after it takes that low. Once it does that, you immediately drop down to a 30-second chart. But I can't have a 30-second chart. Then you can't fucking trade this model. Just apply it to a higher time frame. Instead of a 30-second, use the 1 minute and use the 15-minute and 1 hour chart. Everything's scalable. But I'm giving you something that you can test a lot. There's lots of examples doing this throughout the week, from the beginning of trading on Sunday to Friday's close. There's many instances of you going in and going to be able to back test this and have no bias. And you're going to have losing trades. It's okay. But you have to have whatever that time frame is, the 1 minute or the 5 minute, there has to be a stop run. One of the first primary principles I taught when I stepped out on baby pips is the real move will not happen. The dynamic price runs, where there's magnitude and delivery and speed, that will happen after a pool of liquidity is engaged. That means if the market's bullish, if you think it's going to go higher, I think it's going to draw up to some level, whether it be a high, a relative equal high, inefficiency above market price, whatever that is up there, that you're framing as a reason for it to want to go up, it's far more likely to get up there with conviction and speed if there has been a short-term run on liquidity that's below the marketplace in the form of stops or sell-side liquidity, because the market's going to go down to allow traders to buy those stops. What traders? Smart money. The algorithm is cowtailing to them. It's called handshaking. The market reprices to levels to allow handshaking to occur. That's the real term. That's exactly what's going on. And when those orders are being provided to the participants that are on the sideline, you're not seeing their fucking orders on the DOM, the depth of market. When that is showing those numbers and stuff, their orders are not sitting there. Smart money's orders are not sitting there. They're not fucking sitting there, folks. That's why I'm laughing at you when you're fucking using it and you're asking me, show me your order book, show me your level 2 data. That's fucking bullshit. That's all bullshit. It's spoofing. Their orders are immediately piped in. Immediately. They're not sitting around waiting for you can read them. If they have their orders the size of their fucking orders and the volume of their fucking orders, if they were sitting out there where you could see them, you could really read sentiment then. They're never going to fucking let you do that. Why the fuck is it so hard for you not to see this? Because people on CNBC and people that are allowed to talk on CNBC that have no fucking real clout on Twitter. I've been on CNBC, so therefore my opinion matters. The fuck out of here. When it drops down to take the sell side when you're bullish, whatever that time frame is that has the swing low that it pierces and goes below, as soon as it does that, you have to wait for one candle to be up close. Once it does that, then and only then do you drop down to the 30-second chart and you wait for a fair value gap to form and then you buy. The best one is the first, but you can take continuous buys on a 30-second every time it creates a fair value gap or trades to a down closed candle. You treat it like a bullish order block, and you can turn that single one contract model over time. If you submit to 3 months of doing it, you build discipline and you aim for that liquidity. But here's the thing. You might be just like my son and you're scared. You can't hold a trade. Okay. Best case scenario, put a limit order at 15. 15 handles, there it is. So you're risking 12 to make 15. That's not bad. It's a little bit better than 1. But most of the time, my son has 10, 11, maybe 11 and a half, sometimes 12 handles. And he moves his limit order around if he ever uses it. Sometimes he's honest with me. He says, Dad, I don't have a limit order because I'm afraid if I put it at 10 and it goes to 15, I'll be upset about that. So he's still not disciplined in that regard yet. He's growing, but this model allows him that growth. It protects him from losing a lot because he can only trade with one contract. He can only take one trade per day. He can only do one thing.